This is Justin Pulitzer. This is my weekend review video for Monday, December 26th, 2016. Happy holidays. The year is coming to a abrupt end. Good amount of stuff to cover. Going to just dive right in. So, it's been a long year. We've had Brexit, we've had the FARC vote, we've had Trump. There's been a lot going on. In the end, though, the market has resolved higher. So I'm going to hop into the 7 market keys, get into some of the major market indices, and then hit up some of the momentum stocks that people want to talk about. VIX obviously has been low. I think a lot of people think that because the VIX is low, it automatically needs to go high. But there have been periods of time where we've just kind of bounced low and hung out low. I mean, eventually these usually do resolve in moves higher. This time will be no different, but the question is timing it. I don't find it so useful to play the VIX directly, meaning to buy VIX calls or what have you, because in my experience, to make consistent money in VIX options, you really needed to have an outsized move, like, flash crash type of play, because most of that is priced into the options. Anyhow, we have some important reference lows down here, and the last few sessions has been below the this last reference low. This one was touched, and we've been just banging around low for a while. So, what could you do with this situation? Obviously, if you're playing stocks or S&P, you probably want to be playing directionally with regard to the options, and that would mean, calls, call spreads, or if you want to put in some protection, I have no problem buying some puts or put spreads. I don't know if I would say the near dated are probably worth exploring, but maybe some longer dated ones out to February or so, maybe March. The biggest issue I see for the market is potentially this dollar. Now, I don't want to do a projected move like this. We had the consolidation and then kind of project that higher. But I will say this. If you take this range, this consolidation range, and double it, let me do this in the dollar first. You can take this consolidation range and double it. You can see that we could be looking at 109s. That would be just basically taking this consolidation range as $8.72, tacking it on to the high of the range and projecting that upward. Now, that being said, if you go on a longer term dollar chart, and I mean like multi-decade, this is roughly the 61.8% retracement. Now, I would normally say that would be enough to stall it, but you can see we've gotten close so many times and kind of got to it here, backed off, and now through it. So the dollar has broken out here, and that could be an issue for S&P earnings for companies that do business overseas. And I think that's been one of the reasons why the FANG names in the kind of the tech sector have been languishing. In the past, names like Facebook have reported problems because of a strong dollar. Now, I've drawn in a couple of channels, so it's possible we just make a move up to the channel first and then kind of peel back. You can see we went from this channel, kind of got close between these channel highs again here. Now we're through it, so somewhere in this range I would think may hold it for a bit. And I would also think that the Fed may want to do something like talk down the dollar a bit because it's just gotten so strong. In UUP terms, anything above 26.5 is probably going higher. If we can get back below it, maybe this was a false breakout and there could be an MA test in the works. But strong dollar, market's been looking past it because I think that the market is of the opinion that we can grow our way out, grow earnings quicker than maybe the currency problems will impact. So the bonds. This has been an epic few years, to say the least. And bonds seem to be topping out, and they've come back down quite dramatically with the Trump election. I think people feel that there's going to be a increase in growth, and excuse me, that would mean the I guess, the demand to borrow money will go higher. Now, I think we can get rid of these for the moment. The reference low here was 114.80. That roughly coincides with kind of the end of this volume distribution and the channel low. However, a lot of people are kind of watching this, and I do think it's possible that there's still a quick move down, but I don't know how sustainable that will be considering we've come down from the top in quite a dramatic fashion. I could also see this potentially forming a bit of a rounded bottom here, a little bit ahead of the reference lows, and then maybe making a move back up first. So I've been trying to play around with this. There's really not that much to do until you break this day's range. This is sort of the Fed day. Anything below 116.80 to me is probably a quick short for that move down to the trend line. Anything, though, however, back up over 119.21, which would take you back up over the 20 MA and this consolidation and this whole consolidation range, I think could be a quick move back up to 123s, where it would coincide with the 2009 crash peak and the 50-day moving average. It's also possible at some point we fill the gap. Look where this is. It's about the 50% Fibonacci retracement. So if there was a move back up to 130 to fill the gap and get the half back, that would make a lot of sense to me technically as well. So keeping my eye on the TLT for that move. A lot of people are worried about the interest rates rising and what that could mean for the high yield situation. These are sort of the weaker type of credit situations, but as you can see, this is forming a bit of an inverse head and shoulders, and it is been rallying here a bit. You have a double top here, tweezer top. This day's range to me is very important. Anything above this 86, 84, I think we'll revisit the 87s and probably beyond. Anything back below this range and this swing low, the low of this day was 85, 85, and the swing low here was 85, 75. This was, 85, 85, 85, 75. If this were to be taken out, you can see, look, this is the left shoulder. This is kind of the neckline here. This is the right shoulder. We had a check back to the neckline and the 20-day moving average. Also, look where this breakdown took place from, the 20-day. So for me, you have a confluence of moving average here, a 10-day, a 100-day, and a 20-day. As long as the 20-day holds, I think things are okay. If we start losing the 20, then you might not want to. You might want to try maybe a quick right or right out short on a snap of the 20, and then an add below this 85, 75 probably for a move back to the retest of at least the 200. But as I'm seeing this right here, I like a buy stop up over this 86, 84. Because this to me would have been a false breakdown, and anything back up over that bar would be rather bullish to me. I think that's also signaling some of the strength in oil. This has a big head and shoulder, inverse head and shoulders. Here you had a failed regular head and shoulders. Let me zoom in here. And now oil is kind of just, this was the gap up here on the non-OPEC members participating. That gap quickly filled, but you can see it's firmed up since. So we have a consolidation range, the body of this bar, this recent swing low, the 10-day moving average. So I think as long as we hold the 10-day, the play is probably long. If you lose the 10-day, there could be a quick move down to the 20, but that's not really all that relevant here. It's kind of close, and it's moving up. So my thoughts here are that oil is probably going to push higher up to these 56s, but for me, the must-hold here is the 52-ish area. That was this breakout, 52.22. So anything above that, to me, is more long. And if it gets back into the 52s, you can just play it more flat. Or if you want to, test your hand short, any snap of the 52s could easily quickly see 49s and below again. The XLE is not looking really that weak. It had a bit of a topping move. You have a double top kind of here at 78.45. This is 78.39. So I like putting in a buy stop over that. You can see we're kind of just riding the 10-day, and the 20-day is right below it. So if you can lose this range, this low, the 75.52 and the 20-day, maybe there's a quick move to retest the backside of the consolidation funnel. You can see we had this breakout. Often it's very typical to have a pullback and then the resumption. At the very least, I think the backside of the consolidation funnel would be a right or right out trade for a bounce. Exxon. I think Exxon now is into a new range. This was the move on Rex Tillerson becoming the Secretary of State. It's just been consolidating. Chevron has been kind of picking up the mantle of the most favored nation in terms of big integrated oil names. But I think that this 89.01-ish area was a key breakout. You can see that's where the gap came from. And we have an old reference level here in the 87s. I think that these 89s and 87s are going to be what the new 86s to 83s are. I think that the range is shifted up and that this area here is an area to sell out of the money puts. Like if this were to continue pulling back to fill the gap, I like the idea of selling out of the money puts. So that's my story with Exxon. Speaking of most favored nation, Chevron, this has gotten up here, right? I mean, this really bottomed. It spent a lot of time consolidation, and now it's just in levitate mode. 10-day, anything below there has been not sort of sustainable. I think as long as this holds the 20-day, it's probably a long. If there were any kind of snap of the 20-day, then maybe we'd be looking at the 50-day. But I would think that the 50-day would be a good area to sell some out of the money puts that would kind of coincide wherever the trend is at the time, because I do think at the very least this would probably have to break, make a lower high, and then come lower before there could be any really more serious damage. China. Not acting well at all. I think this is because Trump has been talking majorly tough about China. You can see you had this breakdown of the channel. It tried to get back in, and then it broke, and it could never kind of look back. Was trying to hold the 200, and now is back down. Now, actually, I'm starting to get a little bit more interested in FXI, somewhere around these Fibonacci levels, the 61.8, of course, being the most and best. If we could get down to these 32s, I would be interested in selling some out of the money puts for a quick trade in the FXI. So these fibs here, I think it's a little late if you're short, and you're probably now looking for a bounce trade. I can't tell you whether the bounce is going to materialize into much, but I think it's a little, in my terms, do you have great trade location here? Up here you did, maybe here not so much. And I'd be now more looking to kind of bottom fish it for a bounce than I am to initiate new money shorts. The BABA, we got out so well. This thing has just been a disaster. It's come down a lot. It's really getting oversold stochastically. This, however, is right at the breakout point here. You can see we stopped just shy of this. You know what I say about, I think if this would have touched back hard into the 200 MA in this area, BABA would right now be a lot higher. But we had that kind of half-cocked rally. It couldn't get over the 200 MA, and now it's back down. And it's kind of playing a little bit below this 87.88. So there's a great right or right out trade setup here. This was a gap below the 200 MA, and now we're back below it. Any move that would negate these 2-day bars, like let's say Monday, if you can get back up over the 88.26, I think there's a quick right or right out long, maybe up to even the 92s. Anything below these lows, though, listen, you do have a 50% fib here around the 84s, but I would be really, really interested in targeting this area, right into this sweet spot. The channel low, you have an interim channel, like a less steep channel, which has been kind of supporting, and then the extreme channel. Look where that would coincide with this big consolidation period, the big 61.8, and the channel low. And there are a bunch of reference ranges in here. So I don't know if this is going to be such an easy short. Look, I mean, you had the 79, 68 was a old key level, 81.27 was an old key level. So I think that the rate of the decline into this area, though, for me would be interested. I'd even like selling out of the money puts if you want to play for a short on a break here, I always call it the kind of the chicken hawk way. You can buy puts and then sell like 2 times out of the money, or just do a straight put spread. I like the ratio just because, look, it's come down so much into a reference area. I think that area would be good. If you don't want to F around with that kind of stuff, I think you could just wait on it for that touch. IBB, I have a great right or right out trade for this. Looky here. You have a bit of a reversal bar here. It's not quite seller shut off because you didn't take up at this 75.58. But I like the idea of either a right or right out long over this high early on Monday, particularly if it can get through the 200 MA. I think that this could probably go up even to the 100 MA. If we lose this low here, this quickly below 26.28, I think that this is probably going to come back down and fill the gap to the 250s. So I like playing against Friday's range in the IBB for a quick play. S&P 500, I like to talk SPY. However, last Friday, not this week, but I think the past Friday, we had a 1x dividend. So it's showing a lot more relative weakness than the cash, which is, of course, the SPX. I want to show a couple of quick things. One, I had said that we hit the channel high and that this was a good spot to take profits. Two, I said I didn't know necessarily if it was a good idea to short, because we could do something like this where we kind of just have these small pullbacks and then just kind of ride the lightning higher. That seems to be kind of what's happening. It's just been consolidating here more by time than really by price. There's a range here. This is kind of like this big reversal bar. So anything back up above 228.23 to me is probably going to get the blow off. This is the Fed day. If we get above that high, this is going to probably bust through the channel, and at the very least, I would think at the bigger 1.618 fib extension to the 234. If this just starts to consolidate here and get to the midpoint of the channel, then it's working off a lot of this rally. There's 2 ways to correct, of course: by price, meaning price comes down, or by time. This comes across and we build up, we work off some of the excess, and then it kind of clears for the next run. So I like playing that range as a key, and you can see we are back into it. You have 2 kind of doji days. If you were to lose this low, this swing low here, this 224.67, I think that we probably could have a quick right or right out short just because you're making lower highs and then we'd start making some lower lows. I don't know how far down the rabbit hole we go with that. Maybe even it would just be to the 20 MA, which is really nothing. But the market really isn't overbought like it was. Look how close the 20 MA is. I usually count how extended the market is by how many points you're past the 20 MA. And this consolidation period here has given it a lot of time to catch up. So the market really isn't as overbought as people think. If there were to be a larger dump, I think the 50 MA here would be the target. Look where all of this resistance was, the 50 MA, and it wasn't until we got through the 50 that we could really launch. Look where the 50 is coming up to. It's getting close to the breakout level of the 219.60. So wherever the 50 MA is at the time, I think that would be like on a snap here. I'd be looking for maybe like a put spread or a put ratio for a move down to the 50 MA, and then I'd be looking to reverse back long on the 50 MA if that's so inclined. The expected move this week, I would think that because of where we are in the range in terms of the VIX, that the move down would be more than the potential move up. The move is expected to be $2.20. That would roughly take you up to 227.91 or down to 223.52. IWM, another really good right or right out short entry if it triggers. Look, I was probably one of the only guys who was targeting this 138 area. I said the channel high. I talked about the reference high, and I talked about this. We have a very similar setup that we had here. You see this? We had double lows, a move back up, and then once you snapped here, this was the flush. Look at this. Channel high, a reference low, and now another reference low here on the 20 MA with an inside consolidation doji bar. Let me zoom in a little bit more here. So look, we had a close here below the 10-day. but we held the 20. You know my theory. You lose 10s, you get 20s. If you lose 20s, you might get 50s. Look where the 50 is coming up, basically riding the channel low and getting close to the breakout area, which was never really fully retested. We tried to retest it here, but again, half-cocked and did go higher. I like the idea here of this double bottom. This is 134.81. This is 134.81. Double lows. Any breach of that I like for a right or right out short for maybe at least to the gap fill to the 130 could be. But I do think that even this first time retest here would be more of a buy than a short. Yeah. So a good entry below 134.81 for a right or right out play. You'd have had the double bottom, the kind of little bounce, and then anything back below here to me would be a quick short. If this continues to hold though, and you get back up above this high, this 136.75, I would think we probably migrate back up to the upper part of the range in IWM. Expected move this week is $1.98-ish, so 138.02 or 134.06. Qs. All right, so the Qs have been a little laggy. That's probably because the FANG names have been nothing to write home about. This has just been consolidating in a wedge. It's still kind of hanging out around the 10-day MA. Speaking of which, I just want to backtrack quickly for a moment to SPX. Remember when I was talking about the SPY and the SPX? Look at the SPX showing a lot. It's still well into this bars range, and you're still above the 10-day. That's why I'm looking at the cash here more so than the SPY, because the SPY went X, and the cash, of course, doesn't factor in that dividend. All right. Sorry. Back to the Qs. So we're just consolidating above the old all-time high, which was the 119.66. We've had a couple of quick look belows and fails. If we were to lose this low, 119.65, or maybe if you want to be 119.60, then maybe there's a quick move to the 20. But the problem is the 20 has caught up so much. So I would probably be looking here more to buy that somewhere in the 20, or sell puts, like maybe same week puts. Look where the 100 and the 50 MA are in the 117s. The expected move this week is $1.39-ish. So 121.60 on the upside, 118.81 on the downside. Look where this roughly is, mid-range here. So if you want to play like a short, I don't mind like put spreads for a move here, or a put ratio for like the same week for a move down, like a quickie, and then reverse back to the long, because I do think that this area here is going to show some support. A couple of big stocks to talk about are, first let's start with the, this is not good. I did not go back into the, do not go gentle into that good night. All right, here we go. Apple. So I talked about booking some. Let me first discuss. I got long on this day here. I was actually, I think I jumped the gun a little bit. It had gotten over. The high of this day was 112.43. I bought some call spreads on the breakout here, and the next day, luckily, it worked, and it continued higher. I had said that I was seeing that there was, on days that there were weakness in the market, and these started to get a little bit of topping tails, so it was starting to feel a little stretched. But I was seeing that there was a big buyer in the market, and I said I wasn't sure if it was like a big fund or a big investor, or if it was Apple's buyback. And I started thinking it was more the buyback, because I noticed toward the end of the day when the buybacks stop, like around 3:30-ish, 3:30, the stock would soften more. And I've noticed these days that it looked like they were kind of finishing up. Anyway, you had this gap down. You've held the 10-day. You have 2 days here of strong action. Anything above the 2-day high, which is 116.52, I think that this can shoot back up to the 118s and maybe even the 120s. Below the 2-day low, which is 115.59, I think that there's a quick move back to the 50, potentially even to the 50 MA to retest the breakout. So I like playing long over the 2-day high or short below the 2-day low for a right or right out trade. By the way, I want to go back to that IWM for a quickie discussion. when to know if this trade is working or when to know that it's not. If you lose these lows and it keeps going, it's working. If you lose these two lows and then by the end of the day it closes back up above them in range, that would be, to me, a look below and fail, and you'd be looking then to play long over the look below and day fail high of day, or short below that low of day the following day. So it's a little nuanced. Amazon. All right, so Amazon, I have said that there's nothing to see here until this thing can successfully cross and hold the 50 MA. Look, what the hell is going on here? Look at this. 50 MA held, 50 MA held, breached the 50 MA, and that rally here was where it stopped just shy of it here, and now we're kind of just hanging out below there, below the 100, below the 50. So the 50 is now downward sloping, which is showing some more signs of weakness in Amazon. I know they're killing it in the holidays. I've seen their my UPS delivery men in my building. I live in a big building, and just like in the street in Midtown, and like almost all the boxes were Amazon. I saw a web survey that's saying like 36% or 37% of all online orders are going to Amazon, which is absolutely crazy. I don't even know, but it's possible. So anything back up above the 50 MA on a sustainable basis. This will remain, of course, a short until it's not, but anything back up above the 50 on a closing basis, I think that this could fill the gap higher. If I had my druthers, the ideal scenario would be for this to come down like the rest of retail hard into their number, and then it's along for the earnings. So look at this. This has basically just been bouncing around. It got above the channel, maybe. We get the channel low. That to me would be like if we could get the channel low ahead of Amazon earnings, I would be all over that bad boy. So 50 MA, still the same old story with that. Facebook. We reached my targets up here, the 61.8s, the 128.33, and the 130.43. It got a little bit above. People got greedy. They got cute. They told me, that they know better. And now they're basically messaging me and wondering what's going on here. We broke a long-term channel trend. We're below the 200 MA. Moves above have not been sustainable. This is a bear flag wedge. And if you lose these lows, could complete to the downside. That would actually be great to happen ahead of their earnings, because I think if they rally again and we kind of come up to a lower high and this is bad again, then it could really be lights out for Facebook, because then you'd have had a high with a lower high, and then a break of these lows would get could be the end. I mean, it really could be the end for Facebook. They're talking about, at least for a while. Listen, I've been a major bull on Facebook over the years. I'm not really willing to fully throw the towel in, but short term, technically speaking, I think we're right on or right below the 50-week MA, which we know is important, and that is a must hold. We're below the 120.79 breakout. We were kind of jockeying around there, and now we're kind of trying to defend the 117.59, which we're below. There's a lot of complacent longs in this. I've heard so many people on TV say that they're just looking to buy the dip. I really want those people to get washed the F out so we can have a better trade location, and maybe get back in. But until we're back up above a 200 MA, maybe even a 50 MA here, look where the 50 was so supportive. That's where it broke down from. I'm a little wary, and I'd like to show you on a weekly chart. This is what, sometimes it's important to look big picture. Look at this. This is a bear flag. I mean, we're right on the 50-week, basically almost below it. I don't feel comfortable owning this long until we're really back up above. Look, this was the big crack bar. This was the kind of the failed bounce high and lower. Until you get over 124.61, which was the high of day of this bar, I don't really see a need to be long until either there or a move lower. Maybe even back to 100. That would, to me, be an interesting area for the stock as a potential long. Google. Let's just fly through some of these. Google higher low, starting to make some higher highs, consolidating here. 103.94, anything above there to me is kind of still okay. Below gets a little more iffy. You have a big confluence of numbers here, a 50, 120 MA. So I'm okay being long really against those. Anything below those is a no-go. So just play against the moving averages. Tesla's starting to rally. The problem for me with Tesla, though, is look, the 200 MA has been grim death so many times. This came up from the bottom to the 200 MA. And unless you start getting closes above the 200 MA, I'm a little leery. We know Elon Musk has a capital raise coming in early 2017. This is starting to get a little overbought. So just be wary about that. I'm still leery. I like the idea of selling out of the money puts when it comes down, and I like selling out of the money calls when the stock rallies. And I'll keep doing that or keep recommending that and what have you until it stops working. NVIDIA. So many top pickers, so little time. This looked like it was going to be a bit of a topping tail, but Friday was beast mode above it. If you lose the 2-day low here, I'm cool with a right or right out short down to a 20-day moving average, which has been the support the last few times. So this, however, I'm not in the business of picking tops. Here was the only idea I had for short, which was a close below the 10. We got the 20. We got it immediately, and I said cover. I had so many people telling me, "Oh, you're what are you doing? You have great trade location." I knew this was coming. This is not how these kind of stocks end. This is how they end. But there is money to be played. This was a channel, a back test of a channel. And listen, until the 20 MA is lost, really more than a couple of days, and this was barely conviction. I'm really not interested. I'd rather see this thing come down, bounce to a lower high, and then get interested in shorting. I'm not interested in shorting stocks that are making new all-time highs almost nearly every day. So I think that NVIDIA is any pullback that comes from a higher high is a buy. If it's the pullback then stops at a lower high and then comes lower, then I would start getting interested in shorting it. NVIDIA has no supply overhead, so there is no telling how far it could go. And I think, like I said, the 20 MA will be a buy until it is not. The gap. We're right near where I was talking about. We broke the channel. This area is the reference low is 21.57. The gap fill was 22.78. This day was a bit of a weak bounce, but somewhere in here is probably, I would think, an interesting area maybe to sell some out of the money puts. I don't think this thing is going to completely, fall off the edge of the earth. It's got like a 4% yield, but anything below the 200 MA, I have to say, is a little bit more iffy. So if you want, you could do a rider. Listen, if you want to be, play it the safest way, you can do a buy stop over 22.51, which is the high a day that's kind of bounce. Anything back over that, I think, could rally back up, maybe get the 24s or even potentially even to the 25s. But below this 22.32, maybe we do see the 21s, but this is down an awful lot. Retail has just been getting smoked, but this is an area that if you want to try it for a right or right out play, makes a little bit of sense to me. This Under Armour has been pretty nasty. Let's go into a weekly. We are, however, coming into some important levels. If you take the all-time low, which was like $1 and change, I'm not even going back long enough, 10 years, weekly. Yeah, if you do that, the 50% fib and then the 61.8 of really where the big run took place comes into play right around here in the 28s. If you just take this straight up, it's down in the 21s. So I don't love that this consolidated here and now we're coming into it, but let me pull up on the daily. You can see that this was this gap down of kind of a failed rally up, and now it's back below range. They have earnings coming up. The ideal scenario I would see for this thing to do is to actually just continue selling off into the earnings and then set up for some type of a long because it's come down so much and it would probably have shaken the trees. But listen, in all honesty, anything below this 30, basically $30 is a little vulnerable. If you want to try for a right or right out, somewhere in these 28s, makes sense to me because on the big picture, it's the 50% fib of the the big rally, the all-time rally range. I'm sorry, the leg range. What am I? I'm confusing myself. Let me go back. Of this rally where this really launched off the big rally, this is the 61.8 of the range, and of the entire rally, it's the half back. So if you want to sell some out of the money puts or take a right or right out play, I think that could be an interesting spot. Nike, this has been a rather controversial stock. I was really hoping that this thing was going to have a big flush on their earnings, but instead they rallied it ahead of after hours, and now it's kind of coming back in. A stock that can't rally on earnings usually tends to go lower. I like using this day's range. If you could get back up above 53.35, I think there's a rally up to the 56s. Anything back below 51.55, which was the low of day here, I think that this thing is going to kiss the low end of range and retest the 48s. So we'll keep it simple, stupid with Nike. My big problem with Nike, though, is that too many people are looking to buy it. They think it's going to be this dogs of the Dow play. Dogs are dogs. I'm just going to leave it like that. JP Morgan looks like it's bowling for a hundo. I would love if this thing pulled back to the channel high, somewhere in the 77s, like the 50 MA. Look where the... Hold on. No, boy, what did I do here? Just when I thought I was getting all cool with the charts, they just don't do it. All right, so the 50 MA here has been basically the support. Any pullback to the 50 to me is a right or right out buy. No interest in shorting this thing until it loses at the bare minimum the 10-day. And even then, what are you really playing for? Just like a point or so to the 20? If you want to be cute initially, I think the 20 probably could be a right or right out buy. If you lose the 20, then I think it's a right or right out short. Bank America got my target in the 23s. It has pulled back, not really even that convincingly. I keep getting people asking me, when would I want to get back into Bank of America? You could try it right or right out on the 20 MA. That's basically this bar's range low. Anything below that low, the 22.21, I'm fine with a quick short, maybe even to the 50 MA, where I would be looking to buy it or sell out of the money puts. There's no way that this thing ran the way it did and probably won't get someone at least interested in buying it on a 50 MA test the first time around. Caterpillar, all right, so this has been another stock with a lot of contention. This day was the day, the analyst day. They came out and they lowered their guidance. The stock had a bit of a flurry. It made a new high, which was pretty impressive, but that didn't do much. This check back couldn't quite get to the 50 MA, and now we're just kind of consolidating. So I'll keep it simple. Anything above 94.05, I don't want to be short. I don't even want to be in the play anymore at this point. I want this inside the range. I don't want anything to do with it. Below the range of 94.05, I'm fine with being short. Anything above the 97.39, I think that this thing will be bowling for 105s. So that's my story on CAT, and I'm sticking to it. Glaxo, I had an opportune trade. I talked about buying it down by these reference lows. 2 hammers, higher low, and it's been taken off. It's basically just been riding the 10-day. The 10-day was where it really kind of broke down from. So as long as this holds the 10 and 20, I'm fine with being long. If it starts losing this low, this 37.94, I don't want to be involved. If it starts getting back above the 38.70, I probably want to add. The 50 MA here could be a little bit of resistance. Look, here it was some resistance. Here it was some support. So the upside could be, but this would be a quick play. It really needs to start getting to hold these and then start closing over the 50 MA for more. But I do like that for a quickie, considering the goodness of the trade location. Have to ask yourself, Danny, what you stand for, goodness or badness? The old all-time high in Priceline was 1476.52. You have 100 MA right around here. You're right playing on the 50 MA. This looks like it's just in a bit of a consolidation channel, working its way down to the channel low. So if you want to play, if you're long or whatever, I'm fine with it right or right out. You have a double low here, basically, with the 100 MA. So anything below the low of Friday, I think could be a quick right or right out short for a move down to the channel low. Maybe even this channel low, which is, look, right around the 200 MA. I'd be an interested buyer there. But if you want to play for a quick long above Friday's high, you probably could get a bit of a move higher. Anyway, that's my story. I'm sticking to it. Hell, we got through a heck of a lot of material. Keep it simple, stupid with the ES. I'm talking H7 terms. The Fed day range, we're still inside it, so there's not much to do. 220, 22.72 half is the high of day. The VWAP is 22.59 quarter. The low of day is 22.43. A move above the high is a long. A move below the low is a short. And whichever side of the VWAP you're on is sort of the leaning. We're either leaning bullish or leaning bearish. If you're not following me on Twitter, my handle is @JustinPulitzer. If you like this video, hit the thumbs up. Please leave some comments. Help me help you. Your comments help me make the videos better. Anyway, let's have a great rest of the week. I will try and do a Periscope this week to kind of wrap up the year. Let's have a great holiday, great end of holidays, and preferably a prosperous new year. Have a great week, and cheers.